You're listening to Kitchen Table Finance.
Hey Dave, how you doing today?
I'm doing great, Nick. How are you?
Doing well. The sun is shining. We're hovering right around freezing for another day or two until the cold spell
Yeah,
hits. So
yeah.
I'm gonna hopefully get out and enjoy it today.
Good.
One of those
Yeah.
things you have to do when you remain in Michigan is when
Uh,
the sun comes out, you got to put your face out in there for a little bit because you never know when it's coming
well,
back.
as my favorite European nationality, the Finns would say, Nick, there's no bad weather. There's just bad clothing. So,
I like that. There you go.
yeah.
We today are going to do our vaunted, yes, I'm calling it vaunted, Dave, our
Love it.
2024 fourth quarter market review and upcoming market outlook, where we kind of take a look at what happened and what's potentially on the horizon to give our listeners an understanding
Right.
of kind of what's out there so that they can kind of hopefully digest some of that information and set some expectations around what might happen. And we can kind of go from there.
Yeah. 2024 is in the books. Another year of plus 20% returns on the S&P 500. And the fourth quarter, though, is kind of a mixed bag. Large company tech stocks kept right on cruising, plus
Mm-hmm.
7% for the quarter. But some of the other asset subdivisions, like large company value stocks, fell in value a little bit. And international and emerging markets didn't do so great. Still an overall positive year pretty much across the board for almost every asset class.
Yeah, it's just kind of crazy what happened in the market the last couple of years compared to where expectations are for everyone except for myself last year.
Right. Listen to
So
last week's
yeah,
predictions podcast if you want to
yeah, for
understand his
more
reference.
information on
Yeah,
my current
Nostradamus nada.
gloating. So there's a chart we'll have to put it in the show notes that our friends at East Bay put in their slide, actually from Avantis, which is 2024 in one page. Just kind of talking about all the crazy stuff that happened last
Yeah,
year, and the
yeah,
market just kind of shrugged a lot of it off and kept on
yeah.
going up.
Lots of things that we were worried about last year as we went along. From a market standpoint, none of them turned out to be very relevant at all. I like that chart, like 100 little data points on there of different
It sure looks
headlines
like it. Yeah,
going
there's
through the year, including just every little inflation piece of news, actions by
Mhm.
the Federal Reserve. Um, Japan and the yen caused a big hiccup in the markets, and it just all
Yeah.
proved fleeting. And it last year proved we haven't even mentioned the election. We talked to a lot of different people, right, who have a
Yeah.
lot of different takes on what's going on in their lives and the portfolio. And our clients cut across the political spectrum. There's no easy category other than that they work with us.
Right.
And just regardless of what their political opinions might be, everybody was worried about what was going to happen.
Yeah.
And just were we gonna have a safe and secure and complete election, and
Mhm.
what would happen one way or the other, and the market didn't care so far.
Yeah, it's quite remarkable when you think about it. We really thought there was going to be a lot more volatility last year than there
Yeah.
was, but the market just kind of shrugged it off. I tell you, my favorite bullet point on here is that Taylor Swift ending her Eras tour towards the end of the year. So
Well,
for all of our Swifties out
yeah,
there, she
yeah.
made the chart.
There have been some anecdotal macroeconomic studies of Taylor Swift and the Eras tour that basically it was like adding another state to the gross domestic product last year. I have a
Yeah.
feeling though there's going to be like serious doctoral dissertations written over the next
Oh, I'm
decade
sure.
on
Yeah.
the positive effect that Taylor Swift had on the economy last year.
Yeah. Remarkable.
So
I love it.
yeah, yeah, and that wasn't on anybody's January 2024 bingo card of what was going to be a positive thing in the
No, it
market,
was
right?
not. Well, let's get into our glass half full, glass half empty here, Dave.
Yeah.
What are some of our positive signs going into the
So
year?
as we move into 2025, the economy and the labor markets remain strong and resilient as near as we can see. We have not seen a meaningful increase in unemployment in terms of like relative to the fact that interest rates were increased greatly in 2022, 2023. And we've only just started to see some decrease in interest rates. So that's good. And going hand in glove with that is that consumption in the US also is still strong, and that's supporting gross domestic product growth.
Yeah, I mean, I just think of the labor market. It's like the zombie labor market where you
Yeah.
just can't kill the thing. It just kind of slowly keeps
Just-
moving forward, no matter
yeah.
what happens in the economy.
Economic fortunes go hand in hand. So,
Yeah, well, when people are working, they're spending money, right? So
right,
consumption remains high because people are employed.
right. Well, and when they're confident that they're going to remain employed
Right.
too,
Or can
you
find
know,
another job, or yeah,
yeah,
like that all
yeah,
plays
yeah,
into it for
yeah,
sure.
yeah. And it's not, there's definitely been signs of weakening in the labor market, but
Hmm.
nothing like what we've dealt with most of our lives in terms of uncertainty in the labor market. Like we're getting more back to a
Right.
normal, not bad.
Yeah, well, I think it's interesting too when you like start to peel back the onion of the layers of the onion on the labor markets. Not that every section is doing
Hmm.
well, right? Like we haven't seen tech come back as strong. There's a lot more growth in healthcare and government than
Hmm.
some of the other sections. So it's not like all things are going at full speed ahead. But for all intents and purposes, when we take a look at the whole, it is performing very well, which is a good sign for the U.S.
On the glass half full side, when we talk about interest rates and yields,
Hmm.
there's still now real income and fixed income. And, that's been on our list for a little while now, but that's a positive thing that, when you can take safer investments and have a real positive return on them, it's an improvement. That's good.
Yeah, and I don't know, like when originally trying to think back to when like interest rates started going up, I don't know that we thought they would stick around at this level this long. So it's kind of been somewhat of a surprise in terms of
Hmm.
where they're still at, given where inflation is.
Well, and one thing that happened over the latter half of 2024 is, we saw the Federal Reserve start to lower short-term interest rates, the interest rate that they control,
Hmm.
but the market actually was such that the longer end of the yield curve actually went up in yield
Right.
to a more normal situation. And I think a lot of people just expected, hey, the Fed's going to lower interest rates, so mortgage rates and all of these other rates that are market driven are going to come down. And instead, we've seen those, relatively at least stay
Yeah.
put or
Yeah.
even adjust up. The glass half full side of that is that one of the, strongest negative indicators for the economy in recessions is an inverted yield curve where
Hmm.
short-term rates are higher than long-term rates, and we actually had that for almost 2 years.
Right.
And now we're back to a normal yield curve where long-term rates are higher than short-term rates. So in terms of talking about the overall health of the economy, that seems like a good omen, even though
Yeah,
a
for
lot of people
sure.
are frustrated that they can't refinance their mortgage at sub 4% anymore. Be careful
Right.
what you wish for, right?
Yeah.
And
Exactly.
so why does that happen? Because the bond market's anticipating that there's less recession risk there. It can also
Hmm.
be that there's higher risk of inflation.
Yeah.
There's a couple things that go into how the bond market reacts to economic news, but just the fact that we have a normal yield curve relationship is actually a positive, good
For
thing.
sure. On the investor side of things, obviously, the higher yields, like we talked about here, the elevated yields just means more income in your investment income,
Yeah,
which is cool if you're on the investment side of it. Not
yeah,
great if you're, like you said, if you're trying to refinance your mortgage. But
right.
unfortunately, you can't have both of these things be true at the
Right,
same time.
right. Remember the relationship between low rates and the overall economy, right? If
Yeah,
if if
exactly.
interest rates plummet to where we're able to refinance at 3% again, you may have lost your job in the meantime.
Yeah, right.
So be careful. Be careful what you wish for. Not, I mean, we're laughing. It wouldn't be funny. That
Yeah.
relationship is real. You can't really have one without the other. Next one's going to show up on both sides of the ledger here. So we're going to
Indeed,
talk
it
about the
is.
positive aspect of it first. For the glass half full side of markets and economy, President Trump's policies in general and the incoming, Congress, we would expect to be growth focused and deregulation, right?
Yep.
And you
Hmm.
can argue the pros and cons of deregulation, but from a business economy standpoint, it's generally positive.
Yep, for sure, especially
So,
in the short one.
so that's expected to perhaps provide some stimulus. Now let's talk about the other side of the ledger, and we'll pick it right up with President Trump and potential policies. A lot of those policies are potentially inflationary, right?
Right.
That could mean that the Federal Reserve has to work harder to keep inflation under control, raising rates, which would be a negative for growth.
Right.
And, just in a nutshell, when we're talking about inflation and potential policies, tariffs are kind of the big one. Talked about a very large increase in tariffs. And why is that inflationary? Because the reaction tends to be to pass those costs on to consumers by raising prices. Our companies they still are going to have to import a lot of their materials that go into what they make. And
Hmm.
so, if tariffs are designed to bring some of that business home, that takes time. And the reason it left in the first place is because it's more expensive to do it here.
Right. Yeah.
So either way, you expect that that's going to be inflationary. The other part of inflationary policy there is related to immigration.
Hmm.
And however you want to look at it politically, the math of it is fewer workers in the country, whether they're legal or illegal, means that you have to pay the ones that are legal and that are here more relative, because
Right.
it's just supply and demand, right?
Hmm.
You take out a section of the workforce, whether it should be here or not is a whole different discussion. It raises the price for the remaining labor. It's
Yeah.
just supply and demand. That's a concern on the radar too.
With tariffs and immigration, obviously they're both very political, but just from like the basic 101 econ class, like
Hmm.
more often than not, these tend to be inflationary,
Yeah.
and really have to be just kind of based on what you said. And so that's something that, we've already seen some movement on the tariff side where companies are
Right.
importing extra stuff or trying to get stuff in before some of that starts. And so it might be some time before you see that, really hit. And then, same thing with immigration. I
Yeah.
know that they're working hard on like filling labor forces and things like that. Going to be interesting what those policies end up being. And with tariffs, it's always we don't want to put tariffs on, but also what is the counter reaction of, China
Well,
or Mexico or
right.
Canada,
Right.
and
Yeah.
how does that spiral
Yeah,
potentially?
we could probably spend all day talking about potential outcomes in a trade war with tariffs. So much with macroeconomics, nobody really knows what the exact outcome will
Yeah.
be. Yeah,
Because whenever it happened last was a completely different economy and had different,
right,
pieces and parts to it. And so
right,
whatever happens
right,
now is always going to be different. So this is just
right.
based on what we know about the basics. The other side of it too is because we don't know, because it's a new economy, what we've seen kind of with the Fed, although they haven't explicitly come out and said it, is like we're just going to kind of hold on a minute and see
Yeah,
what transpires
yeah,
before we decide to continue lowering rates.
yeah.
And now the expectation is, two or one rate cut versus before when it was four. And so it'll be interesting to see how they handle that and what kind of data they're getting to make those
Right.
decisions going forward.
And a minute ago, we were talking about the relationship between bond market yields, the economy, interest rates, and so here again, we also have a tension where one of the stated objectives of the incoming administration is to lower housing costs.
Mm-hmm.
And the first thing they look at is mortgage costs. Well, mortgage rates are based on, you know, 10-year treasuries and 30-year treasuries and the expectations for the economy. And if you've got the expectation baked in of increased inflation due to one set of your policies, and you want to control costs on the housing market on the other side,
Yeah.
somehow you've got to reconcile those things. And the answer has been, well, just tell the Fed to lower interest rates. Well, if the Fed lowers interest rates, that's just like putting your foot on the gas as far as inflation is concerned.
Right.
The Fed isn't increasing interest rates to be mean or because they don't want you to own a house. They're doing it because the swings that we get if they don't in the economy are much worse for everyone in general.
We could do another whole podcast episode about housing and how that affects things. But
Yeah,
a couple of like brief points of, when you look at inflation right now, the biggest driver of where we're at is the housing prices, right? Shelter
right,
costs.
right.
And so I think like there's a couple different ways to attack that. One of them is going to have to be policy around like, are we able to build more affordable
Well,
homes,
yes,
apartments, things like
yeah,
that? And part of it's
yes,
going to have to be affordability through interest rates, mortgage rates.
yeah,
It's not just a one side or the other. This
yes,
is a,
yeah.
let's work together and figure this out kind of thing.
Yes. The government in general for the last 100 years has been famous at attacking economic problems from the wrong side of the equation. Oh,
Right.
college is unaffordable. Let's give you more money to spend on college. Well, the
Yeah.
colleges are then going to raise their prices because you've
Yeah.
got more money to spend on colleges. You know, and same with housing. Just making mortgages affordable doesn't really solve the problem. It
Right.
drives up the price of the house then because there's more demand because you've got more money to spend on the house.
Right.
Anyway, I don't think we're going to teach Congress any lessons anytime soon in that regard.
No, I
Because
think just for our listeners, just know that this is something that's going to take a while. Like even if they decided tomorrow to have a policy to build more houses and how to like,
yeah,
that's not going to turn around tomorrow. This is like a, next 10-year project and not a next 10
and
months.
and to bring it full circle, what does it take to build houses? It takes people swinging
People.
hammers. Yeah,
Yeah.
and plumbers and electricians, and we've got short
Yep.
supplies of those. So what happens there? Those costs go up. I get very frustrated during election cycles when I hear voters talking about the economy and politicians talking about what they're going to do about the economy
Hmm.
as though it is like an A plus B equals C equation, and it's
Right.
just not. It's
Yeah.
not that simple, and our politicians do us a disservice when they talk about it that way, and they do themselves ultimately a disservice because it's a no-win situation for them.
Yeah. Bringing it all around, we can close up on this to like making financial planning decisions. I think the
Hmm.
biggest thing to understand out of the whole housing equation is there's no perfect time to buy a house, right?
No,
Like
no,
you'll be waiting forever to find the perfect
right,
interest rate at the perfect
right,
price because it just doesn't
right,
exist.
right.
So think of it more from the standpoint of like, is it really super important to you right now as it relates, especially to your life
Yeah,
and retirement plan,
yeah,
to make those decisions to make that change and worry less about the perfect time, the perfect interest rate,
right,
the perfect house.
right, right. There's a lot that goes into that, and it's never gonna
No.
feel right. Yeah.
Much like you can't time the stock market, you can't time the best time to buy a
No,
house market.
no, no.
All right, with that, we talked a little bit about the new policies and how that potentially impacts the Fed. But then the third glass half empty thing is we've had 2 consecutive years of S&P 500 returns above 20%.
Yeah.
Dave, can the good times roll?
Oh, there's an old cliche that says the market can stay irrational a lot longer than you can stay liquid. Um, don't try just because the market is overpriced and has gotten ahead of itself doesn't mean it can't stay that way. Because the stock market has gone up precipitously over the last couple of years, we now want to see earnings grow to support those prices.
Mm-hmm.
If we don't see earnings grow to support those prices, we're going to see prices come back down
Yeah.
because the amount of what we call in the market the multiple of earnings, like the amount you're willing to pay for a dollar of a company's earnings, stays fairly tight ranged over history. And
Mm-hmm.
valuations right now are very high compared to what companies are earning. So now we need to start seeing those earnings reports show that yes, the market was correct in driving these prices up because companies are becoming more productive and making more money.
Right. Much like our prediction show, it's very hard to predict if
Well,
that's going
right,
to be something
right,
that they can accomplish or
right.
not.
Then we're going
Yep.
to really know one way or the other. So ask again later.
So our last point on here is something that always seems to fall into this category, and that is the geopolitics in Russia and Ukraine and the Middle
Yeah,
East, expanding into Syria. How does that all play out? Does it continue to expand? Do that, we
right.
announced a ceasefire. Is that going to hold on? Is that going to, wind down? Like, there's a lot of questions around that impacts a
Yes.
lot of things all over the world.
Yes. And there always will be, and there always are those questions. Waiting to see how that will impact the markets, and we just don't know. We just don't know. There'll be something new to replace it when that is resolved. So,
yep. So with that, Mr. Shotwell, that is kind of our glass full, glass half empty, half full. Anything else you would like to add about the end of 2024? What to look forward to in 2025?
nothing new, nothing different really comes to mind. We're just going to have to see how things play out.
Yeah, it's always like the same old. I like doing these; they're important. People need to know what's going on in the market. But at the end of the day, what happens in the next 3 months should not impact your financial decisions, your overall financial plan. We're in this for the long haul, so know what's happening and coming down the pike, so you're not surprised by it. But at the end of the day, stick to your guns, stick to your plan, and don't adjust based on something we said here or something that's happening in the market.
That's a great way to sum it up. And to put a pin in it, I would say that none of these are new concerns that we haven't seen, in one form or another throughout our career.
Yeah, absolutely. So with that, if our listeners have any questions for us, feel free to shoot us an email at info@srbadvisors.com. We love hearing from you, and look forward to being back next week, Dave.
Thanks, Nick.
Thank you for joining us for another chat about your retirement and finances. Please hit that subscribe button. You can also contact us at srbadvisors.com or email us at info@srbadvisors.com. See you next time on Kitchen Table Finance.
This is a Zedia Media production.